All right, hi everyone. Welcome to today's webinar on how to trade gold. Right, just before we start, we see a lot of folks coming in. All right, just want to make sure you guys can see my screen. You should be seeing the IC markets webinar PowerPoint slide, the first page, and also can you guys hear me clearly as well? Can you just make sure audio and visual is all good? And do take note that we have the questions window and the chat windows open as well. So please drop your questions, or if you have any other clarifications you'd like me to touch on, please do not hesitate to drop your questions. Right. We still got time, still got a couple of minutes before we kick things off. All right, hi, okay. So we've had Kayum. All right, dropping saying hi to everyone. All right, good. Okay, great. Hi everyone. Okay, so you guys have navigated through the various windows. You can know what the questions are, and I believe there is a chat um, window as well. Yeah, are you guys able to uh, type in the chat as well, or is it just the questions box? All right, and also let's see. Let's go on. Oops, hang on. Just let me. Okay, yeah, just let me sort things out a bit. Okay. All right, hi everyone. All right, Kayum, since you are testing out can you hear me? Is the audio good? I just want to make sure audio and visual is all good. And you see Ash, Anwar, Bob, Mihaila, Monique. All right, Rahul, Piyawan, Richard. All right, good. Everyone's tuning in. I just want to have a sound check and a visual check. You should be seeing uh, the IC Markets webinar PowerPoint slide. Okay, right. Okay, I think we've got everyone come in. All right. Okay. Hi everyone. Okay. Just before we start, just have a quick poll here. So I'm just going to launch the poll. So please let me know if this is your first time or if this is. Oh, wait, hang on. Yeah. Okay. So I've launched the poll as well. Oh, why is it closed? Okay. Sorry. Okay. Something didn't work out right. Sorry. Okay. All right. Okay. Okay. Right Hello, testing, testing. All right, okay, great. Okay, we've got Ans and Adrian telling me sounds good. Okay, sounds good. Jamilu as well. Okay, thank you very much. Sorry, I'm just using a slightly different setup today, so I just wanted to make sure we had video and audio all good. All right, okay, so today's webinar by IC Markets is about on how to trade gold and just also, okay, slide, okay. All right, okay, so right, you can see me and you guys can see the slides. Okay, so I'm gonna go full screen. Okay, so today's webinar is on how to trade gold with IC Market. Okay, IC Markets. Okay, so just a quick disclaimer before we start things off. So CFDs are complex instruments and come with a high risk of losing money due to leverage. Uh, and also, please note that all information that is presented in the slides and in this webinar is purely for educational purposes. Do perform your own due diligence before putting on any trades. All right, okay. So my name is Ketan Ramachandra. I'm investment analyst at Everest Fortune Group, where we have been the best finalists for equity and FX research from 2019 to 2021. And so this webinar is brought to you in a special partnership with IC Markets and Everest Fortune Group. All right, so here's the agenda for today. So we'll start off at looking at some background about gold in terms of demand and production. And then we'll see how effective does gold serve as a hedge against inflation and potential crisis events or recessions as well. And then we'll also look at the relationship it has with the US dollar. And we'll also look at the relationship that gold has with real yields. Okay, so demand and production. Okay, so we have some stats coming up for the years of 2021 and 2022. So for 2021, as you can see, it's a global distribution of demand for gold, primarily comes from jewelry, right? So 55% of gold demand in 2021 came from the jewelry sector, right? Then we had investments at 25%. So this means your ETF investments or futures, any other financial products that may allow you to invest in gold. Okay, Ash has a question whether slides or video will be shared later. Okay, the webinar will definitely be put up on IC Markets website, or you'll be sent the link for it, I believe. So just wait. It'll be put up in due time. So slides will not be shared later, but the webinar will be uploaded onto their websites at some point in time or shortly after this webinar is done. Okay. Oh, sorry. And then we have central banks buying at 11%. So basically, when you have central banks, they're actually buying physical gold and storing it in their respective vaults. And then you have technology demand coming in at 8%. So technology means all your, for example, your printed circuit boards in the electronics sector, where they use it for the PCB gold plating of the PCB electronic traces and stuff like that. Okay, so as you can see, primarily gold demand comes in the form of jewelry or comes from the jewelry sector, which makes up more than 50% or it made up 55% in 2021. And this trend usually doesn't change, or the distribution among the sectors doesn't change significantly over time. Okay, next we have gold consumption. Which countries are the biggest consumers of gold? Okay, so in 2021, we had China and India, right, as the top two. China buying almost more than 900 tons of gold, with India coming in at about 850 tons, right? So, just let me get my power. Yes. Okay. So here we see, okay, this chart, okay, you should be able to see my laser pointer now. So on this chart here, we have on the left the axis for the population for each country, and on the right we have the gold consumption measured in tons. Okay, and the white bars indicate gold consumption, and the slightly grayish bar represents population. So as you can see, China in 2021 consumed about just over 900 tons of gold. India at about 850 tons of gold, and the third largest country by consumption was the United States, coming in close to 200 tons. So as you can see, the China and India by far are the largest consumers of gold, and this is primarily in coming from the jewelry sector, right? As we have seen in the previous slide, 55% of gold demand comes from the jewelry sector, and out of which India and China are the two biggest consumers of gold. Of course, China and India would also use have other demands for gold for the other sectors, but primarily it would be for um, the jewelry sector. Okay. Okay, so this is 2022 gold demand. This is from this website Gold Hub. All right, don't worry, guys. I will be putting up a slide at the end of this section which shows you all the data links from where I got this information from. So you can take a screenshot of that and you can explore it and at your own pace to find out more about that particular piece of information. Okay, so if you can see here, this is not a very good chart, but I will take you to the website later, so it'll probably be clearer there. But basically, this is for 2022 when we had total gold demand. Okay, so this where my laser pointer is. This I guess I would say like slightly red pinkish or like a pinkish box. So this is central bank buying up gold. So this was demand coming in from central banks. So as you can see, through for the last 10 years or so, central bank demand was relatively smaller compared to the other segments. But last year, there was a significant demand uh, for physical gold coming in from central banks. So central banks, global central banks around the world became huge buyers for gold. This was primarily due to the US placing sanctions on Russia after they had invaded Ukraine in 2022, right? In 2022, February, Russia invaded Ukraine, followed by a series of sanctions imposed on them by US and their allies. And one of the things that US did was they weaponized the US dollar by freezing the reserves and foreign reserves of Russia. So because of that, a lot of other central banks uh, became very concerned about this, because if they in the future step on the wrong side of the US, something similar could happen to them. So that is why uh, a lot of central banks started uh, buying physical gold to shore up their reserves. Okay, so this is why we had a significant demand coming in from central banks in 2022. Okay, so there's a website uh, which has gold production as well, just to find out which countries are the biggest producers of gold. So we have China coming in at 330 tons, Australia 320, Russia tied with Australia as well at 322 tons, followed by Canada and the United States. So as you can see, not only is China the biggest consumer of gold, they are also the largest producer as well. Okay, so this is what I was talking about earlier. This is a set of links for the various charts and information that we had just viewed. So you can take a screenshot of this, and you can also go to this website and read more about each particular piece of information in more detail if you wish, right? Okay, so I guess it should be enough time for you to take a picture or screenshot of this. Okay, next we're going to talk about using gold as a hedge against inflation and crisis or recessions. And there's always strong justification for having gold in your portfolios or as a trading instrument to hedge against this sort of environments. Now, how true is that, or how well does uh, this statement hold up? Let's see. Okay. Okay, so this is a chart that is showing us the performance of gold, the performance of the S&P 500 index from 1970 up to about 2022, right? So as you can see here on this chart, the blue line represents the S&P 500 index, okay? The orange waterfall at the back is the price of gold in per ounce. And then in the background, if you're able to see, the gray shaded vertical lines, they are the recession periods in the US. Okay, these are major recessionary periods in the US. As you can see, in 1970s, there was we had a recession in 1973, where you could see gold price clearly rising into the recession and continuing to head higher as recession ended. And of course, conversely, you would see, as you would expect, during a recession, equity markets to pull back. That is why you can see the slight dip in the blue line. Of course, because this graph is, we can't zoom in, so we are not able to actually discern how deep the S&P 500 index pullback. But as we can see on this chart here, on this box, it dropped about 13%. Then heading up into 1982, oh sorry, 1981, we had another recession, where as you can see, as we headed into the recession, gold prices picked up as well, and it peaked and then dropped, and it started rising again as we came out of the 1980 recession as well. So at least in these two instances, it can be seen that gold has served its purpose as a hedge against economic crisis or recessionary periods. However, if you look at the 1981 recession, gold actually continued to slide all the way down in price. Price was retreating all the way towards the end of the recession, and gold only started to pick up as the recession ended. So this is a situation, or was an environment, where gold did not serve as a hedge against the recession risk. Similarly, in 1990, there was a recession in the US as well, and you can see here that gold price actually peaked before the recession started and started pulling back, going sideways, and then heading even lower. So from 1970 to 1990, we had two periods, or two recessionary periods, where the price of gold actually increased, and this would have served as a good hedge against your equity portfolio, or any or just your portfolio in general. But also we see that in 1981 and in 1990 that this wasn't the case. Okay. Similarly, in 2000, when we had the tech bust, or the dot-com bubble, we saw equity markets pulling back sharply. We saw actually gold price dropping and sort of bottoming in the middle of the recession. And as we came out of recession, that was when gold price started to rise. Okay, so way before, and when equity markets peaked, the S&P 500 peaked and it was falling rapidly, gold actually didn't serve as a hedge against this during this inflationary recessionary period. And it was only after the recession ended and economy started to pick up, that's when gold prices started to head higher as well. Okay, so it seems like there's a contradictory, not a contradictory, there is a mixed results when it comes to gold performance or gold serving as a hedge during recessions. Similarly, in 2008, we had gold prices rise into the start of the recession. And then when equity markets peaked and started pulling back drastically, gold prices surprisingly also started falling as well. So you can see in this chart, the price of gold and the S&P 500 bottomed around the same time, right? As equity markets were blowing up due to the labor crisis, gold actually didn't serve as a hedge during this period as well, right? It actually dropped in value together with the equity markets. And then when as we came out of the recession, that's when gold prices started rising and equity markets also started rising. Okay, and in 2020 we had the quickest recessionary period, probably one of the quickest recessionary periods ever, where equity markets quickly recovered and gold seems to have served as a good hedge against recessionary risks in this period. So looking at this chart, it is telling us that gold doesn't always serve as a recessionary hedge in all the time. It is never 100%. So we'll go into more details as to why this is the case. Okay, so this is the next chart, which is just showing is a weekly chart. So I'm showing you the price of gold or gold futures in this case from 1975 to 2000 or to the present time, and the gray shaded vertical bars are highlighting the recessionary period. So this is basically looking at the previous chart, but just zooming in on gold prices and overlaying it with the recessionary periods in the US. So as we said in the 1980 recession, gold actually started rising before the recession started. It peaked, it dropped to about $500 an ounce, and then as we were coming out of the recession, that's when it started to rise, and before reversing and pulling back lower. And when the second recession started in 1981, 1982, gold didn't serve as a hedge at all, right? So this was the period where you would have severely reduced economic activity. Equity markets were also very likely pulling back, and gold was pulling back as well together, right? So this would be a scenario where probably you would have all your, if you had a portfolio of just gold and equity stocks, both of them would be tanking and pulling down your overall portfolio. So this chart is, we are able to look at this chart and zoom in on the recessionary periods to see how the price of gold has actually performed in 1980 and 1982. Then moving on, we come to 1990, the recession in 1990, 1991, where gold, yes, did pick up. There was a slight pickup in the price as recession started. It looks like it went sideways for a while, and as we came out of the recession, gold prices actually started to fall, go sideways until 1993, 1994. Okay, so as you can see, 81, 82, and 1990, gold really didn't serve its purpose as a hedge against recessions. And even in 2000, see 2000 is very clear when you zoom in on the chart here. When you overlay the prices, gold prices versus the recessionary periods in the US, you could see the price of gold was relatively flat throughout this period, right? Equity markets were tanking significantly. You had some economic slowdown as well in the US, but gold was basically just flatlining throughout this period. Okay, now we come to the Lehman crisis, or the great financial crisis, which was triggered by the Lehman Brothers credit event. So gold prices actually started to rise prior to the recession period starting. It peaked at about $1,000 an ounce at the early part of the recession. And as equity markets pulled back hard, in October 2008, gold prices actually fell together with equity prices, right? So right smack in the middle of one of the biggest financial crisis in recent times, you had equity markets pulling back hard, and yet gold prices also dropping just as hard. So it again didn't serve as a recessionary hedge or a hedge against recessionary fears or recessionary periods. And it was only after equity markets bottomed and we started coming out of the recessionary period is when the price of gold picked up or started to rise very sharply. Okay, and similarly in here as well, we can look at it right in the middle of the pandemic lockdowns. The price of gold was rising, and as we had the lockdowns, price of gold actually dipped. It fell down to 1,500 an ounce, 1,500 per ounce before reversing and then going higher. So you can see that there's always statements being thrown about as gold serving as a hedge against certain crises, economic crisis or recessionary periods. But as you can see from the data, that is not always the case, right? It's never 100%. And we will go into this and we'll explore why this is the case in the next few slides. Okay, so it's very important to note that we shouldn't be just buying gold blindly, whether you're buying it as an ETF or as a futures product, or if you're just trading it in your IC markets account as a hedge against your other positions. You shouldn't just be buying gold blindly purely because someone or some news media outlet is saying, claiming it as it's a hedge against economic recessions. Because as you can see clearly in the last two charts, this isn't always the case. Okay. All right. Next is another statement that gets uh, thrown about as well is gold is a good hedge against inflation. Okay. So currently, right now, we are in one of the highest inflationary periods in recent times, right? And let's see whether it does this statement hold through. Okay, so I've only got so far data from 1975 to the present time. So what we're looking at here on this chart is CPI or Consumer Price Index of the US or CPI levels in the US versus the price of gold. Okay, so this is a monthly chart because as we all know, CPI data is released on a monthly basis. So I'm using monthly data points to plot uh, gold futures prices versus the consumer price index of the US. So on the left hand side, we have the axis for consumer price index. So this will all be in percentage level. So we're looking at CPI year over year, or you can also call this annualized CPI. Right, so this is on the left side, the axis. The blue line relates to the axis on the left side measured in percentage terms. And on the right side, we have gold futures prices measured in dollars per ounce as we expect. Okay, so in 1979, 1980, there was also a period where there was significant inflation in the United States, where inflation went as high as 15% at its peak. So as you can see from 1978 to 1979 or early 1980s, inflation was rising very rapidly, right? And it was during this period where the price of gold also started rising rapidly as well. So in this scenario, gold did serve its purpose as a inflationary hedge. So in this situation, if you had, if you were trading, if you're alive and you're an adult and you had an account and you were probably trading here or you had an investment portfolio, you've had noticed that inflation was starting to rise sharply and you decided to buy gold, this would have paid off quite handsomely, right? Now, next brings us to 1983, August 1983. So we had the sharp pullback in consumer price index, dropping to as low as 2% year over year, and then it reversed and started rising sharply, going up to almost 5% again. So during this period, uh, although the inflation wasn't as high as what we saw in the late 70s, but no doubt inflation started rising sharply, but gold actually went sideways and started to head lower, right? So in this instance, gold did not serve its purpose as an inflationary hedge. Now over here, in this period, in the mid 80s, 86 to 87, when inflation started rising pretty rapidly from 2 to 4%, we saw gold rise as well, but not as much as we saw in the late 70s. Okay, so in this case, you could argue that gold did serve its purpose as an inflationary hedge. Now, as we look at other instances here, in 1999, early 2000, again, inflation started rising pretty rapidly from 2 to almost 4%, but gold actually went sideways or was just trending lower, right? So over here, as inflation was rising, gold did not serve its purpose as an inflationary hedge again. And now over here, this period, you can see that this was a period where gold started to rise very rapidly. Now, why did gold rise rapidly from 2002 all the way to 2010? We'll come to that in the next few slides. Now, similarly over here, let's come back to the recent inflationary period where we saw CPI rising in the second half of 2020 above 2% and rising rapidly to go as high as 9%. We did see the price of gold shoot up, right? It rose very sharply, serving its purpose as an inflationary hedge. But as you can see, CPI continued to rise, right? CPI continued to rise, and it actually peaked in July of last year. But actually, gold started pulling back very sharply here, right? So this point here was probably, if I'm not mistaken, is March 2022. It was just after Russia invaded Ukraine, which was actually a major geopolitical event. So you would think that after a major geopolitical event has taken place, you would expect gold prices to remain elevated and move higher. But actually, in fact, gold prices peaked and pulled back pretty sharply, right? So gold prices here hit, I think, about 2,050 per ounce, and went dropped back all the way down to about $1,800 per ounce. So this is a very strange move, right? If you were thinking that a major geopolitical event should keep gold prices elevated as it's a hedge against such events. But actually, in fact, despite rising CPI, despite having a major geopolitical event in February 2022, gold prices actually peaked after that, shortly after that in March, and started rapidly pulling back. And then you could say they were ranging between 2,000 and eight, 1,800 to $2,000 per ounce. They were ranging for a while. It peaked again in the middle of last year before pulling back sharply, right? So as a hedge against inflation, yes, there are periods where gold has served its purpose, and there are also periods where gold didn't serve its purpose as an inflationary hedge. Now, how do we identify which are the periods or environments where gold would serve its purpose as a recessionary hedge or inflationary hedge? Okay, so we're coming to that pretty soon. Okay, so one of the other key aspects of the value of the dollar, the value or the price of gold, is its inverse relation to the US dollar. As we know, commodities are all priced in the US dollars. So just generally speaking, when the value of the US dollar drops, commodity prices generally are supported, right? But also this also feeds back into supply and demand because it's a commodity. And of course, if there's more demand for that particular commodity and you see the dollar, the value of the dollar falling, and in this case, we are looking at the dollar index. You see the dollar index falling, then it's quite likely that um, gold prices should be supported, right? Or should remain elevated. Okay, so what we're looking at here is the weekly chart for the dollar index. So on the top half, we have the top chart is showing us the dollar index. The bottom chart is showing us the gold instrument that you would normally see on your platform, right? XAU USD. So this is a weekly chart. So this is from 2022 to about April of March or April of 2023. They have not updated this chart to reflect the last few weeks of performance. But okay, what I'm trying to illustrate here with this chart here is especially since 2022, when the dollar has been rising as sharply as we saw, because central banks started raising interest rates aggressively, led by the Federal Reserve. Federal Reserve was the most aggressive central bank in 2022. So as they raised interest rates aggressively, the value of the US dollar started to rise, which in turn drives the dollar index higher. We saw US government bond yields rise very sharply during this period as well. So in a period where you have uh, a strong dollar or strong DXY and strong government bond yields rising, this was a period where the gold prices are pulling back. So this is an environment where gold is not a good hedge. In this case, because it was also an inflationary period, you can clearly see that gold did not serve its purpose as as an inflation hedge. So this spike that you see here, this was in February or March of 2022. This was when Russia invaded Ukraine. So you would think that after a major geopolitical event, with central banks raising interest rates to combat rising inflation, you would think gold prices would remain elevated around like $2,000 per ounce, and you would expect it to head higher. But actually, in fact, it did the opposite, and gold prices went down to as low as $1,600 an ounce before bottoming around here and then started to rise. So this happened. Part of the reason why this happened was uh, inflation peaked around July. Inflation start in the US, CPI at a year on an annualized basis peaked and started falling sharply. At the same time, we had the dollar index dropping as well, and government bond yields also started falling. And another key event that took place was the Bank of Japan, right? The Bank of Japan had a very dovish monetary policy whereby they kept interest rates low at negative 0.1%. But however, as the value of the US dollar rose significantly, the dollar yen went as high as 152 in October of 2022. This was when the BOJ, or the Bank of Japan, announced an intervention measure. So, right, so they intervened in the open market by selling their foreign reserves. Remember, Japan together with China are one of the biggest holders of foreign reserves, which comprises of the US dollar and US treasuries. So they intervened in the foreign exchange market because the yen was getting heavily devalued, and they needed to prop up the value of the yen versus the other currency. So they did that by selling the US dollar and their foreign reserves in the open market, and then buying back the yen. So as they did that, this was the period where dollar yen also pulled back sharply, which in turn led to a big sale of US dollars, which caused DXY to fall rapidly as well. And also we had inflation peaking and falling. So we had bond yields falling down as well. So this was a period where gold actually started to rise rapidly. So it's a bit strange, isn't it? We had inflation peak around here, annualized inflation in the US, and started falling rapidly. So you would think in a falling, although inflation was still historically high, but you would think that in a falling, as as inflation was retreating rapidly, gold was actually rising, in value. Okay, so you can see that this relationship between the dollar index and gold holds relatively true. It is relatively intact. Like in this case, it's an inverse correlation. So this is a relatively tight inverse correlation where you have a rising dollar which weighs on the price of gold, and then you have a falling dollar which provides a tailwind to the price of gold. Okay, so next we will look at gold versus the 10-year bond yields as well. Okay, so when you have a period of rising government bond yields, rising dollar index, this weighs on uh, the price of gold, right? Even though we were in an inflationary period, price of gold actually started pulling back rapidly and then going higher. Okay, now how do we combine the value of the dollar, the yield at which like the government bond yields, especially the 10-year bond yield, is quoting us. So what is a good way to give us a very good indication of the direction for the price of gold is using real yields. Okay, so what do I mean by real yields relationship? Okay, so what are real yields and how do they differ from nominal yields? Okay, so as we all know, government bond yields are quoted in nominal terms. So example for the US 10-year bond yield, if it's quoted at 4%, so that is the nominal yield that investors would get when they purchase that bond. The real yields are nominal yields adjusted for inflation expectations. Okay, so real yields, basically, as you can see in this simple equation, is just it's just nominal bond yield minus the expected inflation rate. Okay, so this chart is plotting gold prices versus real yields. Okay, so real yields, as we mentioned before, so this is taking the US 10-year bond yield, government bond yield, and adjusting it for inflation expectations, and then is plotted against the price of gold. Okay, just to take note of the word inverted here. So the real 10-year treasury yield is plotted on an inverted y-axis. So on the right-hand side is the y-axis for real yields, which is an inverted plot. So it goes from negative 2.4 at the top to positive 2.4 at the bottom. Whereas the price of gold, which is charted on this yellow line, of course, it goes from 0 to $2,000 per ounce. Okay, so do take note that the y-axis for real yields are inverted to clearly illustrate the close relationship, or rather the inverse relationship that gold has with real treasury yields. So as you can see here, of course, no correlation or inverted or inverse correlation is always 100%. There will always be periods in time where the correlation breaks down. So we have to be aware of that as well. But generally, this correlation holds very tight. So that means to say that through most periods of time in history, you would expect gold prices to continue rising when you see the real yield going from a more positive value and decreasing in the value and heading to neutral and then heading into negative territory. So this chart here clearly explains why the price of gold was rising very rapidly in 2009 to 2012 onwards. So in this period, as your real yields move from an area of high positive yield and it drops lower, heading towards neutral and finally negative, it means that gold is a better instrument to invest in versus government bond yields, right? Because your government bond yields are dropping in value, the yield is falling in value, right? The real yield is falling in value when adjusted for inflation. And because of this macro environment, where you have real rates going from a more positive to a less positive, and finally to a negative yielding region. This is when the price of gold rises very rapidly. So this, I'll show you where you can access this chart as well. It's a free website that the chart is, I believe, updated every few days or every week. And similarly here, when real yields peaked and started becoming less negative, going to neutral territory and finally ending up in positive territory, was also the same period where the price of gold stagnated, consolidated, and started pulling back sharply. So you can see this relationship holds very, excuse me, sorry, very tight. And in the period of mid 2013 all the way to the end of 2018, where real yields were just moving sideways, gold was also pretty much moving sideways as well. There was no clear direction to the upside or to the downside during this period from 2014 to the end of 2018. So in this period, you would not be looking to buy and hold gold for the long term, but you will be looking at it to trade the ranges, right? This is what we would probably call range bound trading, right? You could do it on a daily chart, weekly chart, or maybe on a smaller time frame as well, H4 and H1. So when you know what real yields are doing and how they are moving, you will understand. It gives you a better insight as to what the price of gold is expected to do. Now, similarly, at the start of 2019, real yields peaked at about 1.2%. It started to become less positive, going up into neutral territory and finally heading into negative territory. It was also around the same period where the price of gold went from around 1,000 or 1,100 or $1,200 per ounce, going to as high as $2,000 per ounce when real yields hit negative 1.2%. Okay, so now the next chart, we'll just zoom in a little bit to show why, after a major geopolitical event in 2022, and why, and also the combination of a major geopolitical event taking place in February 2022, combined with a high inflationary environment, did not cause the price of gold to go higher. Okay, now why is this the case? So when real yields peaked, or sorry, bottomed at negative 0.8, and they started heading into positive territory, this was because the central banks, the Federal Reserve, were raising interest rates very aggressively, causing the dollar index to rise, causing the bond yields to rise. So when in this environment, real yields become more positive, and it causes big institutions and other hedge funds to actually invest in instruments or assets or securities such as T-bills. T-bills are US Treasury bills, and these give a better yield and serve as a better asset or security to invest in. And in this type of macro environment, this is where gold is not an attractive option for such institutions to hold on to, right? So this is why gold was actually retreating in price despite the geopolitical event of Russia invading Ukraine, and also because despite inflation continuing to rise, but it's all the price action in gold was dictated by the direction of the real yields. So similarly here, when real yields peaked at about 1.6% at the end of last year, towards the end of last year, and started becoming less positive, that is also when the gold price started to rise. So similarly, this was when the value of the US dollar was falling, government bond yields were also falling, and real yields were reflecting the price action in the gold. So as I said, correlations always don't hold throughout time. This was one instance where the correlation broke down, or inverse correlation broke down. So you would think when real yields started to become more positive, you would expect gold prices to fall, but actually, in fact, gold prices held relatively steady and started to move higher as real yields then started to move higher again. and then become less positive, and then real yields went more positive, causing gold prices to fall to about $1,800 per ounce, forming a double bottom here, and before rising sharply as real yields became less negative or less positive. So one good way of trying to establish a longer term direction on the price of gold is to look at real yields, right? We don't really have to go into the macroeconomics of why real yields behave as such, or what causes real yields to become more positive or less positive, but it's just to simply understand that there's an inverse correlation between real yields and the price of gold, and by just studying this relationship, looking at the value of the US dollar or the DXY, looking at the where government bond yields are heading. By using these three things, you're able to establish a pretty good direction for the price of gold. Okay, so I'm just going to exit the slides now, and I'll take you to the chart, how to get to this website and the chart. Okay, so sorry. Okay, so if you go to Google and you just type long-term trends, right? It should be one of the first results in your search. Okay, so I'm just going to leave this on for a few seconds so for you guys to take a screenshot or write it down. Sorry, so just search for long-term trends, right? And you should see this website, longtermtrends.net. Okay, so take note of this website. You can click on it, and it gives you all the correlations and inverse correlations or relative performance of all the various asset classes. But we're just going to look at gold for today. So let me close this window, right? So we can go to gold. There's various other relative performance that they have charted for, they've made the charts available for. So what we want to look at is gold versus real yields, which was what we were looking at earlier. So we click on this chart, and let's just zoom into the last 3 years. Okay, so let's see how often is this chart updated. Okay, this chart is okay, so it's okay, it's updated daily, and the last recent update that we have is for Monday, 15th of May, right? 15th of May, Monday. So you can sorry, sorry. So you can use this website and see where bond yields real yields are heading. So you can see real yields have been ranging between positive 1.6% and about 1.2%, right? So you can see real yields have been ranging within these levels, and at the same time, the value of the price of gold has also traded accordingly. So by just seeing where the direction of real yields are headed, we can see where gold prices are expected to head as well. And of course, you can combine this with your technical analysis on a daily chart or a shorter time frame, combine it with your preferred indicators to identify potential entry and exit points. So as we see recently, last week we had inflation data in the US. Okay, so I'm just going to go and to trading view. Okay, so this is my chart for gold XAU USD on a daily chart. Okay, you guys should be able to see this chart. So what has happened last week? We had US inflation data, CPI data coming out on Wednesday, and we had PPI data on Thursday, and we had University of Michigan consumer sentiment survey out on Friday. Okay, so CPI was overall CPI figures were relatively in line with estimates, and they have been pulling back. But one thing to note of, the core CPI reading is not falling as sharply as the headline CPI. Okay, so you have the headline CPI, which is at about, I think, 4.9% now year over year, but you have core CPI, which is still at about 5.5% year over year. right? So now this is a concern for the Federal Reserve. This is also something that institutions and markets have picked up on. They've realized that the core reading, the core CPI reading in the US is not falling as sharply as expected, and is actually consolidating. And there's some growing concerns that this core reading could start to rise. Okay, so that is why with that data point, and also PPI was soft. PPI is Producer Price Index, which measures wholesale inflation. That is actually has pulled back very sharply, and it is not um, uh, indicating any potential increase in inflation in the wholesale segment of the US economy. But we had inflation expectations data from the consumer sentiment survey, which I mentioned. University of Michigan released its preliminary consumer sentiment survey on Friday, and it showed that inflation expectations rising sharply again for the second month in a row. So you have two major data points, which is the core CPI reading in the US is not falling as sharply as the Federal Reserve would like, and it seems to be consolidating and is hinting at picking up over the next couple of months. And you also have inflation expectations data on Friday, which is suggesting that inflation expectations are rising. So with these two data points, is probably the primary reason why you saw the value of the US dollar shoot up very rapidly on Thursday and Friday, right? So this is my chart for DXY, dollar index. Remember, the dollar index is a index made up of various currencies that measures the value of the US dollar versus its peers. Okay, so it is a measure of the US dollar versus the euro, the Japanese yen, Swiss franc, Canadian dollar, British pound, and Swedish krona. Okay, so the most is a trade weighted index, or I mean, it's a weighted index. So that is to say that the euro makes up 57% of the basket, with the Japanese yen making up 13% of that basket. So you have a total of 70% of the basket being dominated by the euro and the Japanese yen. So what that means to say is, if you have a lot of selling for the euro and a lot of selling for the Japanese yen versus the US dollar, you are going to see the dollar index rise, right? So that means the US dollar is being heavily sought after, and the euro and the Japanese yen is being sold off. So in that scenario, you would also see the dollar index rising sharply as well. So as you can see here on my crosshairs, on Wednesday, 10th May was when CPI data was released, but there was no real reaction movement or positive movement for the dollar index. Actually, in fact, it closed in the red on that day. But as markets digested the CPI data in detail, this was when on Thursday when the dollar started to rise rapidly, and then on Friday again when uh, consumer consumer sentiment survey from University of Michigan was released, which showed inflation expectations rising, which was what propelled the strong move in dollar index again. So when you have this sort of data points coming out, which seems to suggest inflation could be potentially creeping back in, is when you can see the dollar being in high demand, which drives up the dollar index. Now on Monday and Tuesday, the last 2 days, dollar has started selling off. This could be a case of um, profit taking, and also it's also sort of attributed to economic data point that came out yesterday, which was the Empire State Manufacturing Index. So this measures manufacturing activity for the state of New York. So it had a big miss. It actually went back into negative territory, which caused the dollar to sell off again. So by being aware of such economic data points and economic activity and inflation expectations, you're able to see how it affects the price of the dollar and then how it affects the price of the or the value of the dollar index, which in turn would drive the price of gold, right? Okay, so just to recap, there's many hang on. There's many sorry, I'm just checking something. I just wanted to know if there's any questions coming in. Okay. Oh sorry, okay. Guys, just feel free to drop any questions that you may have. And what I'm trying to say is, okay, so there's always talk about gold serving as a hedge against recessionary periods versus major geopolitical events versus inflationary periods. But as you have seen in this webinar from the earlier slides, it is never 100%. Gold never always serves its purpose as a hedge against through recessionary periods, through inflationary periods, or through geopolitical events. What is primarily driving the price of gold is the value of the real yield, right? So when real yields become more positive, that means assets such as US Treasury bills become a more attractive investment vehicle, and the dollar and the price and the gold is and gold does not, right? And naturally, when you have real yields dropping, heading from a positive territory down to neutral, and finally heading into negative territory, this is a period where real yields are dropping in value. This is when gold becomes a very attractive instrument for such institutions. Okay, so this is the main I guess gist of today's webinar, where it is very important to take note that gold never serves its purpose as a hedge for all these periods in time 100%, right? There's never 100% certainty that gold will always serve as a hedge against recessions, as a hedge against inflation, as a hedge against geopolitical events. There's other factors driving it, driving the price of gold, and one of the easier way to track it is to look at real yields, look at the value of the US dollar, which in turn drives the dollar index, and look at the value of the government bond yield, such as the US 10-year bond yield. When you're looking at all these factors and looking at the price of gold on daily and weekly charts, you're able to identify long-term bull trends, bear trends, and also sideways action. And then you can zoom in onto the daily chart or 4-hour chart or the hourly chart and identify potential trade setups, right? You could be a swing trader, you could be a positional trader, or you could be an intraday trader. But when you know what is the general direction for the price of gold, you're able to identify better trade opportunities, right? Or trading opportunities. All right. Okay. Right. Okay. So I've come to the end of the webinar. I'm just going to launch. Oh, sorry. Something.